Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market update. We've seen a continuation in bullish upside momentum in the broader markets after last week's major reversal. So let's jump into the charts and see what we've been looking at. Starting out with the SPY, we're coming up against some key resistance, potentially at 450, 350, so we'll want to watch that closely going into next week. Also happens to be the 100-day moving average. So if we can get above both those levels, that'll be a pretty bullish signal for some continued upside momentum in the broader markets. We'll want to keep an eye on that as we could potentially see a short-term pullback off of that level before we actually move higher. But so far everything we're seeing is looking like some bullish momentum is still in place for the market in the short term. Jumping over to the NASDAQ, similar story where we actually got above a key Fibonacci level just in the last couple days, broke that level and then came back and retested it today on Friday, and then came back up and finished right around the key volume support resistance level at 359, 360 level. So if we get above that, then we'd be looking for some more upside opportunity in the NASDAQ. And if we break down below this 359 or 354 level, I'm sorry, and on the Fibonacci support, then that would potentially be a bearish momentum change in the NASDAQ. So we'll want to watch that as a key level going into next week. Take a look at the Dow Industrial averages. We are just above a key volume support level, right around the 347 mark, and so we want to make sure we hold that going into next week. And if we do, then that would be a pretty bullish signal to continue to expect some more upside opportunities in the Dow Industrial averages. Taking a look at our Dow Jones Transport Index, we got a big movement last week in the weekly candlestick. Got above our 50-week moving average and got up against a key resistance support level. Finished off this week where we held above that level, and so that's looking like a bullish opportunity going into next week for the transports with some upside momentum. Take a look at the Russell 3000. Last week we talked about breaking a pretty major downtrend channel and then getting just below the 50-week moving average. We wanted to see it get above that this week, which we did. And so we'll hopefully look for that to maintain that 50-week moving average and go up even higher. And that'll just be another strong signal that the overall markets are looking pretty healthy in the short term. Taking a look at our value line geometric index, we're came up and retested this level from last week, held it as support and started moving back up to the upside. So that's looking pretty well for the geometric index, which tracks about 1,700 different stocks in the New York Stock Exchange. Taking a look at our ex-US all-world index, so we've got everybody in the world minus the US stock market. Great chart that gives us a overall idea of what the rest of the world's markets are doing. We had a massive move off the 200-week moving average last week, and then kind of fell off a bit this week, but then kind of came back up to the closing from the previous week. So that's still looking pretty bullish. I'd like to see it get above that probably 59 level before I got more excited about possibly some stocks outside of the US, but we're getting pretty close to that, so we'll keep an eye on it. The Chinese market actually had a bit of a sell-off this week. It had that major reversal last week after the Chinese government came out and both publicly as well as I think policy-wise supported the markets a bit, kind of well back above the 200-week moving average, but this week it came up against that 3281 level as resistance and sold off a bit. So at least in the short term, that's looking a bit like a bearish reversal in the Chinese stock market, so we'll keep an eye on that next week. Similar story with emerging markets. We had a move to the upside relative to the SPY last week, but then that reversed this week and sold off a bit. So emerging markets really aren't looking like the healthiest place to be at the moment. Taking a look at our Russell 1000, our large caps. We wanted to get back up above that 50-week, similar to the Russell 3000, and we did, and we moved up even a little bit higher on the large caps. So that's showing us that maybe large caps are actually outperforming small and mid caps right now, and so it's looking like our large caps in the US have some nice bullish upside opportunity going forward. Take a look at our Russell 2000, our small caps. We did come up against a resistance level or support level here right around the 204.50 level. We did hit that, hold it as support, and move back up to the upside for the rest of the week. And so that's looking fairly good. I'd really like to see the small caps get above this 209 level to really kind of look for some maybe bigger upside momentum in small caps. But this is at least in the short term looking fairly neutral at worst, and potentially could be bullish if we get back above that 209 level on IWM. Taking a look at our growth versus value, we've had our second week where we moved to the upside, where growth was outperforming value, but we did come up against some resistance there at the 1.66 level and then sold off. So we'll kind of want to watch that closely next week and see if that continues to roll over, and that might show that value is actually starting to outperform in the market in the short term. But we did have a nice bounce in growth compared to value over the last week or two, so we'll want to see how that develops going into next week. Jumping over to the US oil chart, we've seen some real big action in that just in the last month. These are weekly candlesticks, so just in the last month we've had anywhere from a price range of about 91 a barrel all the way up to 130 a barrel. Currently we closed the week out here sitting at about $112, $113 a barrel. Very bullish oil and the energy sector broadly. As long as you stay above that $100 level, I don't think there's any reason to short anything in the oil markets at this point. A lot of supply chain shocks, obviously geopolitical events have added to those as well. But even before that was happening, it was in a pretty bullish momentum regime in the energy and oil space. So I'll continue to look for some nice upside opportunities, trading lots of energy stocks, uranium stocks, and a variety of other energy sector opportunities. Similar story on our commodity chart. We got a big move, really kind of mirrors oil to a degree, but this hasn't been just the oil prices. We've still seen some big movements in some agricultural inputs. Fertilizer costs are going up, and that's a big driver in food costs. And so we've definitely seen some price increases outside of just the oil space recently in our commodity sector. Jumping over to our high yield corporate bonds, we like to look at that for kind of a nice signal around the overall health of the markets. Typically when those high yields are selling off, it's usually a bad signal for the markets. And while the high yields did go down a bit this week, we had a massive reversal last week. And so as long as our high yields are staying above either the 79, 80 level or the 81 level, then I think we're still probably fine in the markets. If we get below maybe the 79.50 level, then that might be a bit of a warning sign. If we fall off below that key level at 79.50, so we'll kind of be watching for that. But everything else I'm seeing is really showing some bullish upside opportunity in the broad markets, and so that's really how we're starting to position ourselves over the last 2 weeks, really. And then if we look at high yield corporate bonds divided by the IEI, which is our traditional bonds, back up a big move last week in the weekly candlesticks back into this range, and we continue to move higher this week. And so if we can actually see high yield corporate bonds break out of this top channel, then that could be actually a pretty bullish sign that the corporate bond market is starting to improve relative to the traditional bond market. And one of the charts we really watch for bullish and bearish signals is our Aussie dollar and Japanese yen. The Aussie dollar is a bullish and risk-on currency, and the Japanese yen is typically a defensive currency. So anytime you look at this ratio chart and you see the Australian dollar moving to the upside like we've been seeing over the last few weeks, that tends to be a pretty strong market signal for the market that we're in a good opportunity with the stock market. And so, and as we've seen, two pretty good weeks in the market, we've seen really strong moves out of the Australian dollar, and so that's looking like that's providing to be a really good signal over the last few weeks, and we're going to be watching that for a possible short-term top, maybe around the 96.50 level, which was at some previous resistance back in 2015. Take a look at the dollar, the DXY, kind of range bound the last few weeks, but still looking like it's got some bullish momentum opportunities going forward. The next key levels we're looking at is the 150 level and the 103.85 level on the DXY. Take a look at our TIPS divided by IEF. So that is your inflation protected bonds compared to traditional bonds. And as you can see over the last few weeks, we've seen a big move to the upside. We've kind of got out of this range bound environment that we were looking at for quite some time. And so it's looking like Treasury protected bonds are significantly outperforming traditional bonds currently. So if you're looking for bond investments, it looks like your TIPS is the place to be right now. Taking a look at our interest rates, the 2-year had a big move this week. We started out at about 1.95, moved all the way up to 2.27 for the close, and so that was a pretty large move in the 2-year yield. We've also seen a big move in the 10-year yield. We started out the week at 2.14. Now we're all the way up to almost 2.5%. So that's been another large move in the 10-year as well. And if we jump over to the 30-year, similar story. We had a nice big move out this week. We actually fell back down below this key trendline resistance, 243, but had a big move to the upside this week and ended up closing at 2.589. And so all of our interest rates are looking pretty bullish to the upside for the moment. And so that anytime interest rates are rising this quickly, typically your traditional bonds tend to get beat up. And when we're looking at our yield curve, still down a bit on the week, but it did seem to kind of slow down the downside momentum that it's been going through over the last few weeks to months. So we're sitting right around 0.2. We're really looking at that for that potential slowing in growth and possible recession signal if we get down to the zero level. So we continue to watch that one closely every week. And when we jump over to the gold and silver space, gold actually had a nice move after a bit of a sell-off the previous week with this big move to the downside a couple weeks ago. That was what looked like it was putting in a potential short-term top, but I still think we got a lot of upside momentum in gold and silver. But it wouldn't shock me if maybe the gold and silver space cool down maybe over the next few weeks to maybe the next month or two, as if we can end up maintaining a bullish stock market environment. It would be surprising to maybe see gold and silver slow down a little bit, but longer term I still think gold and silver is going to have some big upside opportunities coming up in the next few months. And if we're looking at the silver chart, similar to gold, we kind of put in a bottom from the previous week and moved up to the upside. But we really would like to see silver get up above that 24 or 25 level-ish to get above some key volume resistance and get above that level. There'll probably be a lot more opportunity for some bigger upside movements in silver. And when we're looking at the put-call ratio, it's looking pretty normal. We've been pretty elevated, which shows us that people are buying a lot of protection in the markets back here, but now we're back down to a fairly normal middle of the range level. And so that's combined with a much lower volatility index in the VIX. We've ended up going all the way down to the 200-day moving average on the VIX, and we're just above 20. Just a few weeks ago, we were well above 35, and so it's been a big move down to the downside on the VIX. And so the combination of the VIX dropping as well as the put-call ratio ending up in a more normalized range, that's showing that there's not a whole lot of panic in the market right now, and there should be some nice opportunities for some continued upside momentum. So let's finish off taking a look at some of the sectors, starting with the relative rotation graph. Really everything has kind of been weakening on a relative basis, but we're still seeing a lot of nice percentage gains in most sectors, which was very much a different story a couple weeks ago. So if we kind of scroll down and take a look at what those sectors are looking like, really silver and gold over the last 3 weeks is showing that it's down a bit relative to the rest of the markets as well as consumer staples. Other than that, everything is in the green over the last 3 trading weeks, and so it's been a big change. While a lot of these things are in the weakening quadrant, they still are showing some positive returns, and we're still seeing some really strong strength out of the energy space, uranium being the leader over the last 3 weeks. And so still a lot of opportunity to trade off the energy sector, but it's starting to broaden out a lot more than we saw just in the last couple of weeks. And so there's a lot more opportunities in the market currently, taking a look at this on a relative basis. And we'll go ahead and take a look real quick at these 11 major industry groups on the chart, and we can see if there's any interesting developments here. We'll start out with the XLE. We're up against a key trendline resistance here at 78.75. We're just above that at the close, and so if we can see a break up above that level next week, it's looking like some really good upside opportunities going forward in the XLE, which is your energy sector. Financials, I'd really like to see those get back above some key Fibonacci level, which is sitting right around 40.25. If we can see financials break out above that, then I'd probably start looking for some trades in the financial space. Similar story with consumer staples. We're coming up against a key Fibonacci level here at the 75 level approximately. So I'd like to see us break above that before I get into any consumer staples, but if we do see a break above that Fibonacci level, that could be a strong signal that there's some upside opportunities there in consumer staples. Industrials are starting to break out above a key volume resistance level, support level. We've got a Fibonacci target of about 108.60 for potential upside, and so industrials are starting to look pretty bullish, and it looks like there's some opportunity at least to the 108.62 in the short term. And then we saw a pretty big development out of utilities this week. So utilities is typically a defensive sector, but we're actually seeing risk-on assets as well as utilities do well recently. And we are breaking out above a key support line at approximately $71. And then we had a trend line break as well that had been going back for quite some time, all the way back to looks like November of 2020. And so we've definitely looking like the utility sector is in a pretty bullish range, and a lot of upside opportunity in the utility space coming up. Communication services, we are just breaking above a key Fibonacci level at 60 to 65, so we can maintain that going into next week and continue to see upward momentum. There could be some nice opportunities in the communication services sector, which has really just been beat up pretty badly going back to September of last year. And so as long as we're above this Fibonacci level of 60 to 65, and consumer communication services, there could be some upside opportunities in the short term. And we're jumping over in the material sector, up against a key support line, 89.50, similar to the energy sector. If we can get above that level going into next week, then that'll be a pretty bullish signal for the materials sector space. Technology, obviously, as we know, since the beginning of the year, has really been beaten up, but it's really had a reversal over the last 2 weeks. So technology, at least in the short term, is looking like there's some opportunity. We are kind of right in the meat of these moving averages, though. And so I really probably want to see technology get above that 162 level roughly, which would get it above all the moving averages. And if we continue to move the upside from there, then that would be a pretty bullish signal for the technology space. Take a look at our consumer discretionary. We are looking at pretty nice volume support right around the 180, 150 level. We've kind of been hanging out around that for the last few days. And so as long as we stay above that 180 level-ish, then that looks pretty bullish for the consumer discretionary space. Real estate's looking interesting. I'm kind of watching at a key level on that, right around the 4750 level. If we can break above that level on the XLRE, and that'd be a pretty bullish sign for the real estate sector. And we'll finish this thing up with the healthcare. Healthcare's had a nice move to the upside over the last few weeks, and we're right above some key volume support, a real big volume support level around 132.50, but also a smaller one around the 136 level. So this is starting to look pretty bullish for some healthcare upside opportunities, and as long as we're above that 132.50 level, it looks like there's some opportunities in the healthcare sector. Make sure to download the Toro Alerts app in the App Store, and you can play around with it for free. And then if you want to sign up for premium services for trading options and stocks, you can use the promo code so you can get 1 free month. Thanks for tuning in, and I'll see you next week.